Welcome to Value Investor TV podcast. This is episode 14, Income Statement, Part 1, the podcast that helps you grow wealth and become financially independent. My name is Beko, and this is Hari. Welcome, everybody. Okay, let's get into income statement. All right, in the previous episode, we talked about overview of the three financial statements: income statement, balance sheet, and cash flow statement. And then we talked about the differences between all of them at a higher level. And I'm sure it was filled with things that just kind of went over your head, maybe. This episode and subsequent episodes, what we're going to do is we're going to dive deep into each one of these statements and clarify all the terminologies that we mentioned in the previous episode, and make things straight. Okay, let's dive right into income statements. So why don't we start with the definition of an income statement first?
So this is how much money is the company earning in a given time period. So whether that be a quarter or a year, how much did they earn, and not only that, so it's essentially, as we talked about in the last episode, the top line you start which is what we sold, subtract all of our expenses out, and then how much did you make at the end of that, or lose in some cases,
right?
And it follows a different accounting model than called accrual-based accounting. So it's not when the cash appears in your from when you sold or bought. It is when the sale is made. So that distinction is very important because a lot of businesses buy stuff on credit. So they have 30 days to pay their suppliers, or 60 days, or 90 days, depending on the terms, and they may ship the goods and get payment later. Yep. And so all of those things are accounted for multiple times, both on the but on the income statement, it's when the sale happens, not when the company gets paid.
Yep. So I just wanted to mention a couple things on that definition right there. It is earnings in a given period of time. So again, earnings or losses in a given period of time from operations.
Yep.
Okay, and also another important fact, this is accrual-based accounting. This is not cash-based accounting, and we'll talk about the differences later down the road, but this is very important distinction to remember. Income statement goes by accrual-based accounting, and this is earnings or losses in a given period of time.
Yep.
Okay, let's start from the top line. We talked about this in a previous episode. So an income statement, Hari mentioned, everything if you look at any income statement, there is a certain anatomy to it that is followed by everybody.
Yep.
Income statement always starts from top line and goes down to bottom line. And top line to bottom line, this is the revenue without deducting any expenses. That's a top line.
Yep.
And as you go down, like Hari mentioned, this is a reverse triangle. This is a reverse pyramid. This is a funnel. You start with the most money, and then you deduct out all the expenses, and you're left with the tip of the triangle. That's the bottom line. So why don't we go down the pyramid and tell us what are deducted every row as you go down.
So if you're not clear, these terms are synonymous: top line, revenue, and sales. And so whenever you hear one or the other, and they may all three may be used. Top line is more of a nickname, but revenue and sales are basically the same term. So that is when a sale happens when a company makes the product available to the customer. So in the case of our hot dog stand, let's say our hot dog stand has a catering business, and it also has a restaurant. When I make the sale to the customer, in this case, the customer walks in, they ask for a hot dog, they pay me money, and I get that. So I'm booking the revenue right then. But let's also say that in the catering business, a customer says, hey, I need 100 hot dogs for my company picnic. I will pay you, next week, right? So you send the goods to the customer today, and that's when you book revenue, because that is when you made the customer revenue available to the customer, or with the product customer. There's also what's called a backlog, which is orders that have been placed but have not been fulfilled. And that is for our discussion and purposes, you won't see that on a financial statement, but sometimes the company will report that. So these are things that the company has contracted for. In the case of manufacturing companies and things like that, and they put that in the backlog. But that is not a sale, because the sale they haven't made the product for the customer at that point. So, then Costco has a very interesting model here that I think we may want to talk about later, because it could complicate this picture a little bit. But if you think about it, they buy stuff on essentially on credit, and they have a long time to pay it off, and so they are able to sell all of the product that they bought on credit before their bill is due. So in essence, that helps. It doesn't change their income statement, but it improves their cash flow, because they don't have to spend a lot of money to buy the items, wait until the items are sold, and collect the money. So they can actually sell the items without having to pay them, and then repay their suppliers.
Right.
And so you're probably wondering, why are we talking about that? That, that sounds really complicated and so on. These concepts are going to be very, in a lot of ways, if you're not familiar with financials and accounting, it may feel a little bit weird. And this is by far the hardest part about investing, is learning the financial statement. So if you don't understand that, you may have to listen to this podcast a few more times, go and read some annual reports and so on. But, getting back to it, just the top line revenue and sales. So the first thing we have to subtract, the first expense, is what does it actually cost to make that? In our hot dog case, there are two things, right? The raw materials, which are the buns and the hot dogs, and the labor associated with paying for the actual manufacturer. All right. So very important to understand the labor for the executive team, the people who are, the fat cats in suits, they don't get paid on this. They're not accounted for here. Yeah. Right. They are accounted for later in the process. But these are people who are actually doing, working on the food line, assembling the hot dog, cooking it, cleaning the hot dog, apparatus to make the hot dogs and so on.
Yep.
So when you subtract from revenue, you subtract the cost of the sales or the cost of the goods sold, you get what's called gross profit. And so that gross profit kind of tells you how much does it cost to actually make the good, right? But obviously there are more expenses in the process of making things, right? Yep. The first of those is selling and marketing expenses. So this is going to be a selling, general, and administrative could be merged all into one line, but we're breaking these out. And sometimes it's also abbreviated as SG&A. So selling and marketing are advertising and sales commissions. So if our hot dog catering business has a salesman or saleswoman who goes out to businesses and tries to drum up business, and she gets paid based on a commission based on sales, that would be deducted here. If we also run ads on Facebook and newspapers and TV ads and radio ads, that would also be deducted in the selling expenses. Then there is general and administrative. So these are sales for the fat cats that we talked about. The executives get paid, or they're accounted for here in this. In addition, we pay rent, and legal fees are put into this thing. So then next, our hot dog business doesn't do a whole lot of research and development. But let's say that we have an online store that you can order online, and we developed software to do this. So we would pay employees who build the software, and they do research and development into building the application that runs on this. So that would be called research and development expense, or R&D. And then the last one in this section is called depreciation and amortization. So we're going to talk about amortization in a little while, but it's an abstract concept, and I don't want to bog down on this right now. So we'll talk about it a little bit later. For right now, let's just talk about depreciation. So think about this as, this is an abstract concept, right? And you wonder why this is part of the income statement, and it has a lot to do with taxes and other things. But in essence, what is it, you're trying to tell a story here. The story is, I buy a building, and over time that building is worn out from use. And the wearing out of the building is an expense that I average out over a period of time. So if I buy equipment that is supposed to last 5 years, then I deduct 20%, or the whole cost divided by 5 is 20% every year, and I mark it as an expense. So you're probably wondering, well, it's not an expense, is it? I mean, the physical item isn't falling apart 20% a year. It may be still good, just as good as it was 4 years from now as it is today. But this is, again, we're trying to tell you a story of how much of our items have been, have degraded over time, and that is marked both on the balance sheet and expensed here. So this is an expense, and it is actually a real expense that companies endure, but it is marked on the cash flow statement when they replace the equipment, and that may not be every year, it may be every 5 years. So depreciation is a very important expense, and it has a lot of impact on different types of businesses. So heavy manufacturing companies have a lot of replacement costs to replace their goods that have been sold, and other businesses have and some have no depreciation costs. So pure software companies don't have any depreciation expense because their software doesn't wear out over time.
Yeah.
All right, so when we take away selling, general, and administrative, R&D, and depreciation and amortization, we get operating profit. So we went from the top line to gross profit after we subtracted the cost of goods sold. And then after we subtracted the operating expenses, which is the label for selling, general, and administrative, amortization, and marketing expenses, we get operating profit. So operating expenses, operating profit. So you subtract the from gross profit, operating expenses, you get operating profit. And so that operating profit is a very, very important metric. And I don't want to to sell it short, because when we start evaluating companies, this will be a critical metric from which we compare competitors. So how much operating margin, which we'll talk a little bit about later, how much money did they make on the business after you subtract all of the expenses related to it. And in the next episode, we'll finish the income statement. But for right now, to give you a real understanding of why this is such a critical thing, is it's now you can compare apples to apples against a competitor. So if I have a business that generates my hot dog stand generates 20% in operating margin or operating profit relative to the revenue, and another hot dog stand only gets 10%, I may have a superior business. And that may be because I'm better at controlling my costs and other things. So it can tell you a lot about how the business runs.
Yeah. And we'll talk about that later down the road on the second episode. Excuse me. But a key takeaway of this episode is our journey from top line to bottom line. And the way I understand it, the way I first understood it is you start from top line and you make a few stops along the way. You make a stop at the gross profit, you make the second stop at operating profit, and you get to the bottom line, which we'll talk about in the next episode, which is the net profit. So there are 3 different stopping points, and they all tell different stories.
Yep.
So starting from top line, that funnel that we talked about earlier in the episode, that reverse triangle, your journey from top line to bottom line will tell you a lot about the business. And so that's another way of understanding and trying to wrap your head around this. It's from top line to gross profit and operating profit, and then we'll talk about in the next episode, net profit.
Yep.
Okay. Thank you, Hari. So this was episode 14, Income Statement Part 1. A lot to talk about in the next episode as well, so stay tuned. We'll see you on the next episode. Thank you, guys.
Thanks.